I'm Owen Bigland. This is the Inside Edge video blog. Wanted to do another blog on Canadians' debt levels. And this has been in the news for quite a while over the last couple of years. They continue to talk about new stats coming out about how Canadians are taking on too much debt. And for a lot of them, I'm sure that's true. I do read these articles saying that a good percentage of Canadians, something like 40%, wouldn't be able to withstand a unexpected expense of $1,000 or more, which is crazy to me. In other words, a lot of Canadians are living paycheck to paycheck. But I wanted to just give you my commentary on this as well. And in talking to a lot of people in the financial business in Canada and in the United States, and you know, the fact that Canadians are taking on more debt in some cases, to me, says that, hey, they're doing what they should be doing, taking advantage of the record low interest rates we've had over the last 5 or 6 years. Now, I know myself and some of the investor clients that I deal with, the successful investor clients that have got fairly large both stock and real estate portfolios, they've been doing the same thing over the last 5 years. Many of them have been taking out lines of credit on assets that they have, whether it's real estate holdings, taking out lines of credit at very low interest rates at prime plus a half point, and buying additional properties. They're taking advantage of this cheap money that's out there. But the difference between them and some Canadians that maybe are overextending themselves is that a lot of these guys have got funds on the sideline that if interest rates start to go up dramatically, we've had a couple of quarter-point raises here, so not a huge amount yet, but if they continue this way, they can easily put some more money down and clear some of that debt, or get it to a point where the income is offset with what they have to pay on the mortgage. So, like anything, take advantage of these low interest rates, but do it responsibly. Don't overextend yourself, and make sure you leave yourself a buffer. Now, you know, a prime example would be, if you've read my book Along for the Ride, you'll know that in my book, I tell people that everybody should own a basket of Canadian bank stocks. The Royal Bank, the TD, Bank of Nova Scotia. Pick the whole basket of all 5 big ones and just hang on to it and sock it away. And, you know, you can keep it in your RRSP if you want, but I also talk about it in my book. You really should start holding a lot of those Canadian dividend-paying stocks, like the banks, outside of your RRSP, and take advantage of that Canadian dividend tax credit, where you're taxed on the dividend at a very low rate. It's really the best way to plan for retirement, is to draw down those dividends or take out those dividends, pay 10% tax on it, and use that to live on. Now, as I speak, September 2017, the Canadian bank stocks can't get a break. It's funny because they're making money just hand over fist. Quarter after quarter, they're setting new records as far as revenue and profit margins and everything else, but they really can't catch a break. The stocks have been going sideways or trending lower for the last 10 months. You know, you can buy most of these Canadian bank stocks right now and get between a 4 and a 5% dividend yield, which is fantastic. Part of the reason is because there are a lot of short sellers out there right now that think the Canadian banks are too exposed to the housing market. And again, I'll give you my commentary on that as well. I don't know about if that's so true. You know, if you dig a little deeper, you'll find that the loan to equity ratio in Canada and in the lower mainland especially is quite low. You know, a lot of people have a lot of equity in their homes. As a matter of fact, it's a very high percentage of people who live in Vancouver and on the lower mainland that own their home free and clear title, or have a very small amount of mortgage on it. You know, the majority of people now, a lot of people buying homes are putting down conventional mortgages, 20% or more. So it's not like the situation we had in the US, where you were putting down no money down or borrowing 110%. You needed a new truck to buy that new car, or new house, we'll give you another $50,000 over above that to buy yourself a new truck. You don't have that in Canada. And, you know, I'll give you a prime example here of why everybody should own Canadian banks. It's really a license to print money is what these Canadian banks have. I've just read an article recently in the Financial Post that talked about how an investor in the Canadian banks over the last 40 years, and I guess I've owned the Canadian banks for probably 25 years, so I can speak firsthand on how well I've done over the years owning the Canadian banks. But I saw a number that said if someone were to invest $10,000 back in the 80s in a basket of Canadian stocks, or put that same $10,000 in Berkshire Hathaway, you would have actually done better in the Canadian bank stocks. And Berkshire Hathaway has done phenomenal. So that's to show you how powerful owning and what a great investment owning these banks are. They've been paying dividends for uninterrupted dividends for 50, 60, 70 years, and they keep increasing those dividend payments every year. But back to my point, here's how crazy it is. The banks are trading at a forward PE of about 10 or 11 and yielding 4 or 5%. They can't catch a break on any price appreciation right now. Just recently, we had several quarter-point interest rate hikes. And immediately, once the Bank of Canada announces that 25 basis point or a quarter point raise, the Royal Bank, TD, all raise their lending rates by that same 25 basis points. But here's why it's a license to print money. They raise their lending by the full quarter point, but on their high interest savings accounts, they raise it by 5 basis points. So 5 basis points, they do a 25% increase on lending the money, but only give the savers 5 basis points back. So that 20-point spread, 20 basis point spread, guess where that goes? That goes straight into the bottom lines of the banks. And they did this same thing 6 weeks ago with the previous one. So this is why owning a basket of Canadian stocks is really like owning a printing press for money. Now, the bank stocks, in the short term, just like real estate, they're going to have their ups and downs. But if you go on to Google, Yahoo Finance, or any investment website, and have a look at the 20 and 30-year graphs of TD and Royal Bank and Bank of Nova Scotia, and then have a look at what those would have returned for you if you would have reinvested the dividend as you got it into more stock. It should be a core holding for everybody who's watching my blog here. Everybody should own a basket of the Canadian stocks. Great to have it in your RRSP, but as I talk about in my book, your RRSP is probably only going to provide you with about half of what you're really going to need for retirement, depending on if you have a pension, which most people don't. So you should be starting to stockpile some of those Canadian bank stocks outside of your RRSP. Put it in your cash account. Collect those dividends, reinvest the dividends, and you're paying an incredibly low tax rate on those Canadian dividends. That's what makes it so powerful. And I go into detail on that in my book. But that's just my kind of thinking right now on what's going on with interest rates and Bank of Canada and the Canadian bank stocks, and why everyone should own them. And sometimes, the headlines about Canadians taking on too much debt, I know that there are definitely a lot of people that are overextending themselves, but in a lot of cases, a lot of the clients I work with, sure, they're taking on more debt, but it's good debt. They're leveraging, they're using those cheap interest rates to buy more appreciating assets like real estate. And they have a buffer. That's the important thing. That if interest rates started to increase here a couple more times, they have the money on the sidelines to either clear the debt or pay off some of it to take it down to what their tenants are paying them on those mortgages. So you have to use it. You have to use it sensibly and conservatively. But in these lower interest rate environments, I'm certainly taking advantage of them, and I think a lot of people are. I'm Owen Bigland. Thanks for watching. I'll see you next week.